All right, we are back from our break. Hello, everyone. Again, I'm Vernon Lee, one of the co-founders of the Hampton Roads Youth Foundation. Thanks for all of the attendees that responded to the poll questions. Hopefully you really enjoyed the last panel. It gives me great excitement to introduce our next speaker. And this is a very special segment because no matter what your careers are, whether you have a summer job, professional, financial literacy and budgeting and taking care of your money and preparing for not just tomorrow, but what you execute on a day-to-day basis is critically important. So it's my great pleasure to introduce one of our sponsors, Bank of America, and someone that is going to share some really insightful things around financial literacy, Mr. George Reynolds, Vice President of Bank of America. Thanks for joining us today, George. The mic is yours.
Thank you for having me. Good morning, everyone. Like I said, my name is George Reynolds. I'm the community banking specialist. I'm a financial center manager at the Victory Boulevard location in Portsmouth, Virginia. And today I would like to just sit down and have a quick conversation, a quick presentation about banking. It'll be pretty high level, but we can go into detail when we get to the panel questions. That's okay. One of the biggest questions that we have or opportunities that we have here in the financial industry is for the 18 to 24-year-old demographic. And one of the biggest things they do talk about is money management. And, what can they do to be successful and making sure that they are setting a firm foundation for themselves going forward. And the first question is, why do people put money in the bank? One, to make sure your money's safe, because if you have money in your pocket, it gets stolen, you don't have that money anymore. You have it in the bank, you have some security, you have some insurances through the federal government, through the FDIC insurance, which covers up to $250,000 if anything happens to your account. Another reason why you put money in the bank is one, to earn money. You earn interest on your money based on the amount and the time that you have it in the bank. The convenience. Everyone now is using debit cards. You do get access to debit cards to use and make purchases, the convenience of getting your paychecks early through direct deposit, and just the overall convenience of using credit. The debit card is credit. And then you always have a record of your transactions. And that's awesome because you get to establish and create a budget for yourselves. So oftentimes, many of you may have heard, it's not how much you make, it's how much you spend. And knowing where you're spending your money and being able to track it is essential for building wealth and making sure that you have the funds available to do the things you want to do. And the other thing is to establish a relationship with a financial institution. Because as you grow in your athletic career or professional career, as you stated, you're going to need to build relationships. And one of those things will be, establishing credit. You may want to purchase a home, you want to purchase a car. And the thing is, there are companies out there that will finance you, but without having a relationship. When you have a relationship with a financial institution, you normally get better rates and you see a better return on your investments as well. The difference between checking and savings account. A checking account is how you use to pay for your everyday expenses. Use the ATM card to do withdrawals, do cash purchases. You can write checks, transfer monies to pay bills. Right now, electronic payments, paying bills online through bill pay services is huge to save money and time. And you earn interest on your interest-bearing accounts. A savings account is typically how I tell my young people when they come in is how you pay yourself. You save money for big expenses. You save money for future expenses. A lot of you are going to college. You want to save up money so you can have money to, purchase the things that you'll need when you go to college, bare necessities or some of the books and things like that. And you also, with a savings account, you can link your checking account and savings account together to help balance your budget. Different ways to pay. Cash, of course, is an easier way. You have that, you spend it. Once you spend it, it's gone. If you lose it, it's gone. That's one of the cons. Using a debit card, you can control your spending. You can also you have a way to monitor what you spend by getting your statements each month. And then you have credit cards, which we'll discuss a little bit detail. And the credit card is a safe and easy way to pay, but it's also incurring debt. That's the credit is basically you're saying that I am going to pay you back in the future based on future income and your responsibilities. And when you're talking about starting a budget, you have to start with the income. You don't want to spend more than what you're bringing in as income, whether it's allowance or from a part-time job. So you should always sit down and kind of categorize the things that you are going to use it for. And, being that most of you guys are in high school, a lot of it may be entertainment, it may be for clothing, it may be for just extracurricular activities, but you still don't want to go over that budget. And starting to learn how to make a budget early will help you be successful later in life.
Sure. Just one question on that budgeting question. Should they just get a piece of paper and write down a budget? Should they use an Excel spreadsheet? Should they use their cell phones, the memo section? What would be the best sort of tool for especially high school students to actually start to write a budget and categorize some of those things?
That's a great question. There are literally hundreds of apps out there that can help them, which I know they're app driven right now. So saying you're dating us when you say paper, pencil and paper. So yeah, using their apps out there, their programs. You can use a Excel spreadsheet on your computer to just track your expenses. Gas, food, fat, whether you're eating out, whether you're going on a date and you're going to the movies. All of those things can be tracked, and they have different apps that I actually encourage my daughter, who she would see me and my wife at the store, and her thing was, just swipe it on a debit card, just as long as you had a debit card, she thought we had money. And I said, you got to work to get some money in here. So that was part of, we got her a checking account early so that she could understand that, okay, you have $50 in the bank. You can't go out and spend $150 because you don't have it in the bank. So, and we got her to track her expenses using an app. And through the Better Money Habits website that is available to everyone for free. There's some paper logs, there's an access to apps that will help you do that as well.
Great, thank you.
Okay. And going back to the budget, when you're talking about a budget, you have to think about a few things. What are your wants versus what are your needs? Your needs are things that you're going to need to be successful. When you hopefully go to college, you have to purchase books. That is a need. You may have to purchase toiletries. That is a need. Now a want is to go to the concert that may be coming to the local venue. That is a want. That is something that you probably need to budget for as well. If that's a big concert, coming up, Beyonce and Jay-Z coming to town, that's a $300 ticket easy on the nosebleed section. So, that's something you need to put in your budget. Say, hey, they're going to be here next April. Let me start saving for those tickets now. Versus the want. The new Jordans may be coming out. Everybody wants a new pair of Jordans. My daughter and my son hit me in the pocket every 6 months or so. But I have to budget for that. I plan for that. Okay, that's going to be easily $500. I want a pair too, but I sacrifice my needs because I can't wear those to work. It don't look well. It may be fashionable to wear with a suit, but Bank of America doesn't allow that in the dress code.
I have a couple of pair myself, some AJ1s, but
I got a pair in my closet I've never worn since '98, so I don't know when I won't get a chance to wear those. But those are all wants, and and the same thing. You're thinking about transportation. It may come a time when you need a car. Do you need a Honda Civic? You may want a Mercedes, but you need a Honda Civic for your basics because there's a big price difference in that, and you have to budget and be able to plan for those expenses as well. Let's talk about credit a little bit. Credit is basically you saying that as a financial institution that as Bank of America, I'm going to lend you some money to cover expenses with the guarantee that you're going to pay me back in the future. And that goes for all financial institutions, whether you're going to purchase a car, whether you want to purchase furniture, even clothing stores, they have their own version of credit as well. And with credit, comes a great level of responsibility. And I know one of the questions in the panelists that we had is, when is a good time to get credit? Every person that comes in here that is of the age to get credit, I have a very candid conversation with them. When you get credit, credit is a huge responsibility. It's not something that, you should take lightly. Oh, I'm gonna get this card, I'm gonna run it up to the max and just pay the minimum back. No, that is not what credit is designed for. Credit is designed to help you establish how much it may not, right now it doesn't look like a big factor because you're still young. But as your credit history grows, your credit history follows you. And it tells the other creditors how likelihood you are to pay, how quickly you are to pay, and how responsible you are with paying. So when should you get credit? It just depends on your maturity and your budgeting, and when you're financially able to pay it back. Because oftentimes what happens as a young person and having parents, we feel like if they make that mistake, that we as parents will help them cover the gap. That should be the full premise of getting credit. So the question was, and I'm jumping ahead a little bit, and I apologize if I'm throwing the panel off, but 16 to 18, if you have responsible parents that are going to help you, guide you through the credit process and monitor that for you, then 16 to 18 is a good time. If you're going to be responsible for it yourself, I would say 19 to 21 would be a good time. And if you don't have the right role models for credit as well, so they got to think about that. I hear a lot of the times here in the financial center, when you talk about credit, they turn their face up and they say, "Oh, my parents or my grandmother said credit is evil and credit is not good, and don't get credit cards." That's all based on their personal experience. A lot of times, people aren't educated on how to use credit, so they do misuse it, and it does hurt them in the future. But credit, in the future, when you want to buy a house, when you buy a car, that could be the difference between you paying the 2.39% annual percentage rate for financing a vehicle versus paying 15 to 20% because your credit history is not established. So,
and George, just on that, how does that translate when you talk about interest rate? A 2.9% interest rate versus an 8% interest rate. What is that? So especially for some high school students, what does that mean over a long term in terms of what you're actually paying back? How does that interest rate translate to them?
So I'm going to just use simple math. I'm going to go with $100 just so it's easy. So let's just say if you borrow $100 from me, and I'm going to say you're going to pay me back 2.9%, that means you're going to pay me back over a year. You're going to pay me back $3 for borrowing the money, is where that calculates out. Now, if you at 20%, so that's for that same $100, you're going to pay me back $20 over the year, which, it doesn't sound like a big difference, but when you're looking at financing a house or financing a vehicle, that could be, for a house, that could be over $100,000 in difference in the interest that you're going to pay. And for a car, it could be easily $5,000 to $10,000 more. You may buy a $20,000 vehicle, but if you have a higher interest rate because you haven't used your interest responsible, you'll be paying over on paper an additional $10,000 for a $20,000 vehicle. Versus someone who has the lower interest rate, they're going to pay about 22 to 25 for it. So, and then credit history, most companies look at a 7-year history. So right now, most of you guys are in high school, so you may not have a good credit history. And to get a loan, most companies want to see that you have 4 lines of credit. So opening a checking account does help you establish some credit. It shows that you're using responsibly, but that is not a big indicator on how you're going to pay back your credit. What impacts your credit? Paying your bills on time. So if you do incur a bill or pay a debt, make sure that you're paying it on time. Make sure you have in your little budgeting tool your due dates, how much your minimum payment is. And also remember, if you can always pay extra, pay extra. If you can pay the balance off in full, pay the balance off in full, because all that gets reported to your credit, the credit bureaus, and that is part of your rating as well. Monitor your accounts. There's a lot of people out there frauding you. I have a daughter who is about to go to college in August, and I wasn't even aware. And I try to stay up on top of most of the scams, but there's a scholarship scam out there now that are attacking the kids going to college, and they're saying, "Hey, you've been awarded a scholarship, and you have to send X amount of dollars here in order to receive a scholarship." Just remember, for any scam, and share this with your family, your grandparents, your mother, your father. If someone says in order to receive something, you have to send them some money, it's almost 10 times out of 10, it's a scam. I can promise you right now, I probably saved some of my senior citizens over $1 million and just telling them that something's a scam, just based on, that premise that they have to send some money in order to get some money. That's not how it works. If most of the time, if you win something for Virginia Lottery, they're going to take the taxes out before they give you the check for the winning, or they do have that ability. So you don't have to give them money to get money. So keep that in mind. And remember, when you're using your credit, you don't want to use all your credit. You don't want to run your credit card up to the limit and then just to pay it off. If you do have to use your full credit, have a plan to pay it back. And when I'm discussing emergencies with my young adults, I tell them, okay, you have this credit card. When you get to college, an emergency is not, my friends want to order some pizza and I'm going to order $60, $70 worth of pizza. That is not an emergency. An emergency is you have a flat tire on the side of the road and you need to get it fixed in order to get home and get wherever you're going. So that's the difference between emergency. And I always tell them, if you can't reach your parents, you can call me during business hours and we can talk about what an emergency is versus that. So keep that in mind. And remember, if you have an account that you're not using and it's a credit account, you can close it because that will affect your credit as well. Okay.
Sure. Just on that one, because I've heard different things. I've definitely heard that around, hey, if you're not using that account, you should close it. And not to get overly complicated with it. But then I also heard that there's this whole balance thing in terms of having a certain number of accounts open and having a balance at a certain amount. Not to overcomplicate this thing, but
okay,
how do you, especially for some of the high school students and their parents that I'm sure are watching with them, how do you make that determination around how many accounts to keep open versus closed? Is there kind of a best practice, like no more than 2 credit cards and 2?
No, yeah, there's a ratio that you need to look at. Okay, so let's just say in having multiple lines of credit open is not a bad thing. The bad thing is when you have over a certain percentage. When you're looking at your credit score, 40% of your credit score is the balance that you're carrying and your credit utilization. So if your credit utilization, they would say you should try to keep it under 40 to 50%. So if you have $30,000 worth of credit, then you should try to keep it under 15,000 to show that you're using it responsibly. I tell people that are trying to build and increase their credit to keep it under 25 to 30%, to show that you have it available, but you don't use it. And the thing with credit is kind of like an oxymoron. You want to show that you don't need it. You have it, but you don't need it. But if you're maxing the card out, or you're maxing out and you're over 50%, that shows that kind of reads to the people that want to lend credit that they may be getting to the point where they're overextending. So you want to keep it. I recommend 30 to 25% to keep a strong credit rating, especially if you're trying to build credit. Now, if you have like a store credit card, like a Macy's or a Dillard's card, they normally have a higher interest rate and a low limit. So they're getting max return on a small risk. If you have a major credit card, use those. Or if you have the store credit cards, make sure you're paying those balances off in full, because most of those credit limits, the APRs on those are over 30%, which means you're paying a lot of interest. And the way they compound the interest is a little bit more frequently than a major credit card.
Okay, so I'm hearing there. So that's a good point. So if it's a store credit, pay it off each month. Absolutely, don't carry a balance.
Uh-huh.
If it's a credit card, sometimes you got to manage cash flow, so you may not be able to pay the whole thing off, but you should aspire to make sure there's no more than 30% on a balance that you're carrying.
Right. Correct. Okay. And I tell when people are establishing, there's going to come a time when you may have to buy a set of tires. When you're buying those set of tires, you go ahead and put it on your credit card, but have a plan to pay it off. Okay, I spent $800 on my credit card, so I'm going to try to pay $200 a month to pay it off as quickly as possible. Because the other thing you don't want to run into, if you do charge, have an emergency, you don't want to get on what's called a slow credit. And that means that you're paying the debt back, but you're not paying it back quickly or not paying it back fast. So let's just say you put $1,000 on your card and it takes you 2 years to pay it back. So you get deemed a slow credit. You're making your payments on time and your payment history is awesome, but you're just making the minimum payments. You want to always try and make more than the minimum payment, even if, like if your budget doesn't allow you to pay the balance off in full, or it doesn't make you make a large payment, try to put in as much as you can. So if the minimum payment is $50, pay $75. Or pay $100, or pay as much as you can, because that shows that you're not letting that balance just sit out there and you're making that minimum payments.
Got it. All right, thanks.
And one last thing, like I said, building your financial know-how is not something that happens overnight. A lot of us, yeah, we need financial guidance. I've been in the financial industry for 20 years, or actually 21 years next month. And, I've learned a lot just being in the financial institution, in the financial centers, because, you get to meet a lot of different people with a lot of different perspectives. And, there's a lot of bad advice out there. There's a lot of good advice out there. Find a banking center or a manager or someone that you trust, or a banker that you trust, and just have a candid conversation with them about what you want to do in life, what you want to do in the next 3 to 5 years. I want to go to college. I need to save up money. Help them we can help put plans in place for you. Parents that are out there, you have kids that are going to college. What are the best avenues for financing college? Whether it's through savings, 50, was it 529, or different plans like that. Because college is expensive. I think a few years back, the average 4-year college for annual was over $21,000, and with room and board. So, and that's with no scholarship or no financial aid. So, I guess we can open it up for panel discussions.
So, George, we actually have a couple of questions in the chat. I'm gonna throw these out.
Okay.
I think we've got about 3 minutes to before we do the poll question. But if we can maybe get to a couple of questions. So one of the questions was, does having multiple checking accounts affect my credit score?
No, having a checking account really doesn't affect your credit score either. Or only times it affects you, unfortunately, is if your account goes negative and it's forced closed through the banking center, then that does get reported as an obligation, a debt obligation that you may owe.
Great, thank you. Rio Walker, who was one of the panelists, guest panelists on our earlier Career in Sports, mentioned that he got a credit card his sophomore year in college, I think when he was about 19. Do you recommend, is that about, we had talked about credit cards earlier. As a freshman, is there any best practice there? Does it depend on your financial situation? Like, what's a good time to sort of to try to apply for a credit card?
Well, when you're, because 18 is normally when you're classified as an adult and you can apply for credit on your own without having a parent or a guardian be a cosigner. It goes back to the individual. Some people at 18 are ready for a credit card and can handle that responsibility. Then other people, young adults at that time, unfortunately, are not. Anytime you apply for credit, I think in your parents' household, I think you should have a conversation with your parents that, hey, I'm going to get a credit card, so that they're aware, and then they can help you, guide you through the process. And if you don't have a person in your home that can help you financially, be as financially as possible, it's just like a good coach. You want to find somebody that can help you, whether it's someone in the banking center, whether it's an uncle or aunt, or a cousin, someone that can help you make good financial decisions. And I think with the recent changes to the NCAA, with these kids, they're going to be able to make money off of their likeness.
Right,
They're
right.
They're going to be coming into more money than they're used to getting at one time, and they're going to probably get exposed to credit opportunities. So they just have to be mindful and having those open and candid conversations. Like I said, I was fortunate enough that my mother was very financially and fiscally responsible. So she was able to sit there and talk to me. And that'd been a different conversation. Unfortunately, if I didn't talk to my dad, because he was not as responsible as my mom. So you have to find the right person that can help you and assist you with that. I mean, like I say, it's just like a coach, like a financial coach, a football coach or a basketball coach. You have to have those people in your corner. So.
No, that's great. I do want to squeeze in one more question from Randall. Great question, Randall, that you have here. George, he's asking, students that take out financial aid, how much does that affect their credit? And what advice can you give those students that take out financial aid?
And when you're talking about finance, you're talking about specifically about loans, right?
I'm thinking he's talking about student loans because there's parent loans that you could get when you fill out the FAFSA, then there's student loans.
Right.
But on the first part of the question, like how much does that affect your credit? So if you take out a loan as a student, does that impact your credit?
It doesn't impact your credit immediately, but it does when you start paying it back. Because it is a deferred loan, and I think you may get it as you can get it all through college, and then you have a couple of years to. Now, when the payments start kicking in, you start have to make those payments. That's when it starts affecting your credit. So you have to make sure that you're paying that on time. So it doesn't affect you from it does affect you from a debt to income ratio, but it doesn't affect you unless you are not paying it back right away. So initially, when you get the loan, it doesn't affect you from a credit perspective because it's not showing up as a debt. But once that obligation comes due, then it does affect you.
Awesome. I know we could talk about this all day, but we got to keep things moving along. George, thank you so much, Mr. Reynolds. We're going to throw the poll questions up now.
Okay.
We've got a couple of questions that related to financial literacy that are going to go up here in a moment. It looks like the current poll questions are the results from the previous panel. So if we could get the new poll questions up. There we go. So everyone, all attendees, go ahead and take a couple of seconds to complete this poll. Mr. Reynolds, so if parents and guardians want to get in contact with you, can we share your email in the chat, or what would be the best way? Can you share it now? Or
yeah, absolutely. My email is george.w.reynolds@bofa.com.
Yeah, hopefully one of our Eric or Asia could get that and share in the chat. That would be awesome. Mr. Reynolds, could you repeat it one more time so they could get it and share in the chat?
Yep, it's George, GEORGE .w.reynolds, REYNOLDS @bofa.com.
Awesome.
And I know I know that Asia and I forgot the other young lady's name. They do have my email address, and they can more than happy to share it if there's a place at the end or wherever they want to put it.
Great. Maybe what we'll do for everyone who's signed up, we'll send that out as a follow-up as well. That's
Absolutely.
Great. Thank you again for joining us today, and thanks again to Bank of America for all of your support.
No problem. Let us know how we can help in the future as well.
All right, great. It has been, for all attendees in the chat, you can see Mr. Reynolds' email address. You can reach out to him for any follow-up banking and advice and insight. All right, we got the poll up here. We're going to get ready to close that up.